This week's 1044 is brought to you by Chevron Delos 600 ADF Ultra Low Ash Diesel Engine Oil. It's time to kick some ash.
This week on the 1044, how are fleets responding to the recent surge in insurance costs?
Hey everybody, and welcome to the 1044, a weekly webisode from the editors here at CCJ. I'm Jason Cannon, and my co-host on the other side is Matt Cole. Rising insurance costs have been a major issue for trucking companies for years, and those costs have skyrocketed in the last 3 years. According to a new study released by the American Transportation Research Institute, per-mile insurance premium costs are up 47% over the last decade, with a 16-cent per mile jump since 2019.
ATRI's latest study looked at not only why insurance costs are on the rise, but also how carriers have responded to those increases to cover the costs. We spoke with Dan Murray, Senior Vice President with ATRI, who talks about the findings of the study.
Everything ATRI does, as you know, is sort of a pre-approved priority of our research advisory committee. And for almost a decade now, we've been collecting annually financials from motor carriers of every size, owner-operators up to the biggest of the big. And we've been watching over the last solid 3 to 4 years, insurance costs per mile in our operational cost research increasing, oftentimes double-digit annual increases. And so about a year ago, our research advisory committee said we really ought to do a deeper dive into what's going on with insurance rather than sitting by and just passively watching the increases. We need to understand what's going on with coverage, premiums, premium costs in particular, and then what the industry's response has been. So we did spend 2021 collecting up a substantial amount of data from carriers of all sizes under a confidential data collection process, and then also went out to the insurance industry and collected up their insights and their guidance in terms of trends and data. And we married all that data together and ultimately concluded, as you can see in the report, that insurance is going up dramatically. The cost of insurance is going up dramatically. Coverage levels, as a response to managing the cost, coverage levels are coming down substantially. The increases have no real direct relationship to safety. We saw, carriers who increase coverage, reduce coverage, whatever they did to manage the cost increases. Their safety outcomes, at least the previous years, were not related to the increases. And we identified in the report, a series of explanations. Economics outside of safety is a big player in this. The commercial auto insurance industry has been losing money for a solid 3 years in a row. And so they basically, had to turn the screws and put an end to that so that they can stay viable. And we saw quite a few insurers just leave the industry. So that dramatically reduced capacity, reduced competition, and there again, prices went up. And then lastly, closely related to litigation that, we've done 2 reports now on nuclear verdicts, small verdicts, and social inflation, which is sort of a relatively new term to describe as an explanation really in terms of cost increases that don't map directly to damage costs. So we're seeing litigation costs go up substantially, so that if you were to look at the exact same crash type 10 years ago versus today, it might be 100 times more expensive. And social inflation is really everything from the jury accentuating the damages, to the plaintiff bar accentuating negligence and liability, to even medical costs that, at least when it's related to litigation, seem considerably higher than what you and I might just pay on the street when there's not a crash related, issue. So all of this tells us that insurance costs have gone up substantially, and no matter what you do as a carrier, I hate to say it, at least in the short run, it's not going to make a big difference.
Dan mentioned one way fleets have tried to counteract rising insurance costs is to decrease their excess coverage levels. The results of those efforts didn't necessarily achieve the intended goal, but the results weren't all bad.
There's a legitimate debate and very little data, but a legitimate debate on whether raising the minimum coverage, which is $750,000 now, will protect the industry or whether no matter what the amount is, that's what the plaintiffs are going to go after. We don't really have a clear response to that, number one, from a litigation standpoint. What we do know in talking with the insurance industry is that many to most carriers are above the $750,000. That's why we used a $1 million minimum, because most of the data was showing that the carriers, even owner operators and 2 or 3 truck fleets, are at $1 million or even 1.5 to 2 million. So just naturally, maybe fear of litigation, fear of exposure, our industry is moving upward from the minimum of 750. And I think that's a good thing, because just supply chain inflation right now is increasing the cost of a truck bumper or a truck grill. So I think that's a wise thing to do. What it does, though, is it creates exposure. If the plaintiff bar, particularly for nuclear verdicts, doesn't care what your coverage level is, they're going to pick an arbitrary large number and go after it. Anything above your excess coverage is direct financial liability. And we've heard carriers over and over say that if I were to ever get successfully sued for anything over my 5 million minimum or my 3 million minimum, we just close the doors. We file bankruptcy and close the doors. And we've seen that dozens of times in the last several years. So that is the risk. So when we see reductions from the very largest fleets down through small fleets of coverage levels, 40 and 50% reductions, I think it was a 55% reduction among very large fleets, they know from the headlines that, lawsuits successfully won lawsuits of 50, 90 million. I think it's ridiculous to say 1 billion, but that showed up in Florida, of course. Those lawsuits are happening. And so it is a little bit of a Vegas odds game to reduce your coverage and not respond accordingly with other safety initiatives. Carriers who knew they very actively and deliberately were raising their risk by dropping coverage levels, they saw improvements, statistically significant improvements in their crash rates. Crashes went down, and we, hypothesized that a carrier who knows they're exposing themselves to litigation risks by dropping coverage levels, oftentimes 40 or 50% decreases or more, they make an extra effort through safety culture, possibly technology investments, certainly driver training, more focus on equipment maintenance, all of those other things that they have direct control over, ultimately did benefit safety.
While it's important for fleets to continue boosting their safety efforts, being a safe carrier likely won't lower your insurance premiums. It will make your increases more manageable, though, compared to a fleet that's not as safe. But before we hear more from Dan, let's hear from 1044 sponsor, Chevron Lubricants.
Protecting your diesel engine and its after-treatment system has traditionally been a double-edged sword. The same engine oil that is so essential to protecting your engine's internal parts is also responsible for 90% of the ash that is clogging up your DPF and upping your fuel and maintenance costs. Outdated industry thinking still sees a trade-off between engine and emission system protection, and Chevron was tired of it. So they spent a decade of R&D developing a no-compromise formulation. Chevron Lubricants developed a new ultra-low ash diesel engine oil that is specifically designed to combat DPF ash clogging. Delo 600 ADF with OmniMax technology cuts sulfate ash by a whopping 60%, which reduces the rate of DPF clogging and extends DPF service life by 2.5 times. And just think what you can do with all the MPGs you're going to add from cutting your number of regens. But Delo 600 ADF isn't just about after-treatment. It provides complete protection, extending drain intervals by preventing oil breakdown. Before, you had to choose between protecting your engine or your after-treatment system, and now you don't. 600 ADF from Delo with OmniMax technology, it's time to kick some ash.
If you had a marginal safety record, you're going to pay considerably more than a carrier who has a stellar safety record. So you can't walk away from safety. And while our analysis did a statistical test on investments in safety technologies and discovered that there's not a direct correlation between lowering your rates and increasing your adoption of safety systems, in the long run, I believe that trend will flip-flop. I think over time, the safety technologies will minimize crashes and minimize risk and probably dramatically minimize our number of trips to the courtroom. So over time, while this is me talking anecdotally, safety technologies are a good investment. So in fact, I think they probably separate the marginal carriers from the stellar carriers. And the stellar carriers at the end of the day won't pay as much of an increase as the marginal carriers. What was disappointing was, as I said, that the direct relationship wasn't there. I never would want to send the message that a focus on safety is not going to help you. It's ultimately going to decrease the rate of increase. But at the end of the day, we're all going to pay more.
While recent years have seen exponential increases to insurance rates, the insurance industry seems to believe that will soon level off to some degree.
Now, we did note in talking with the insurance industry that they indicate that these exponential increases in annual rates are moderating. So we're expecting in 2022 to see much more nominal increases rather than these, call them almost catastrophic increases. So I think we might, I'm not saying we've turned the corner on losses in insurance, but I think the comfort level by carriers and insurance is that, going forward, it's going to be a bit more tolerable than it has been the last 3 to 4 years. We're hopeful that this moderating effect that we're hearing about, not yet seen, the renewals aren't coming in until probably summer, that we might be experiencing high single digit increases rather than double digit increases. If the economy continues to stay hot for 1 or 2 more years, I believe that commercial auto insurers will have turned the corner on the operating in the red, and again they may see an opportunity to moderate our rates. They're not going down. They're absolutely not going down. But I think we could find enough stability that in the renewals that we can build in, moderate nominal increases in our shipper contracts, and then proceed as we are with, safety improving and reasonable increases in insurance. But we're just never going back to whatever the good old days were in the insurance premium world. We're not going to see that anymore. We're just going to have to build this in as a standard cost to business and move forward and look for other areas to develop efficiencies.
ATRI's report found that for a certain segment of fleets, an insurance captive could be one way to lower insurance costs and maintain a comfortable level of coverage.
A captive is a group of, let's say, like-minded carriers. Ideally, they'd all have similar and high safety focus, similar and low crash histories. And what they do is they essentially pool their risk. They pool a large amount of money and tap it as they need to, and everyone has equal access to that same pool. Now, quite candidly, it's absolutely conceivable and happens at times where just 1 or 2 carriers will completely liquidate the available pool. You still can have these unexpected and catastrophic crashes where you're paying millions and millions. And that then reduces access to the other captive carriers in your group. So the pressure is on to continuously identify and attract and recruit really good carriers for captives. And they're typically small to medium-sized fleets who don't have, again, that large capital base to cover high self-insurance rates, et cetera. It's becoming more palatable, but increasing pressure to make sure that your peer group is as safe or safer than you are. And that bar just keeps getting higher and higher. Ultimately, raising the bar within captives is good for the industry because it's basically saying we're improving safety, we're decreasing crashes, and we're pressuring our peer group to do the same thing. So they share a lot of strategies on safety management, safety benefits, investment strategies. So the model for captives is much more collegial in terms of, hey, we're all in this together. Let's work together to improve safety amongst ourselves, and it'll reduce ultimately our insurance costs because, again, we won't liquidate our total coverage, and it may also minimize the amount of premium increases we have because, again, safe carriers don't pay as much as marginal carriers. So I think that the captive model could increase even considerably over the next few years as long as those like-minded, safety-sensitive carriers can find each other and continue to share, again, their strategies for maintaining high safety standards.
While lower insurance costs aren't likely, Dan says there are some things fleets can implement that can help keep their increases in check come renewal time.
I think the future, Matt, is still going to be safety technologies. And we just wrapped up our Techcelerate program with FMCSA. They should be releasing the final report and an ROI calculator that we built that allows a fleet to develop their own customized cost-benefit analysis for different technologies. So I think that report, when it's released, that calculator will give carriers a lot of insight of all sizes. But I think at the very least, road-facing cameras, which is part of our suite of safety technologies. People say, how does a road-facing camera reduce crashes? Well, it can reduce crashes if the information is used in training, but it also can keep us out of the courtroom. And that's very, very important. When we don't do anything wrong, when we're doing all the right things, a road-facing camera clarify that very, very quickly. Even on the roadside with enforcement standing there wondering who to issue a ticket to, they'll look at the video feed and it's very, very obvious who's going to get the ticket. And most of the time it's the car driver. So I think a lot of these technologies, particularly as their prices come down, and more carriers use them and understand how to build that into training and their total cost of risk. I think we're going to see most of these systems become standard equipment rather than options over the next, for sure, 2 to 3 years.
That's it for this week's 1044. You can read more on ccjdigital.com. As always, you can find the 1044 each week on CCJ's YouTube channel. And if you've got questions, comments, criticisms, or feedback, please hit us up at 1044trucking@gmail.com or give us a call, 404-491-1380. Until next week, everybody stay safe.